You've all heard that stocks rise over the long term. That's been our experience. In fact, over the last 125 years, stocks have averaged a 10% return. So if you think about our history, the last 125 years have not exactly been the calmest. World War I, World War II, hippies, disco led us up to this moment, but still we've averaged a 10% return throughout that entire turmoil time. Another factor to consider for positive investment performance is the length of time that you're invested. On a one-year basis, the S&P 500 has about a 74% chance of being on a positive. On a three-year basis, it goes to 85%, 90% on 10 years, and after a 15-year time frame, it's 100% positive. So the length of time somebody is invested, the higher percentage of chance they have of a positive return. That includes riding things out through a down market or making adjustments along the way, which is what we tend to do to try and minimize volatility and still maximize your returns. Market timing can be costly. If you jump off to the sidelines without having a new buy-in strategy, something that is tried and true, you can greatly reduce your overall performance. If you miss just the best few days, your performance return can be 24% less over time than if you were fully invested. So we want to make sure that we have an investment strategy that allows you to stay invested, yet not have too much volatility so you can't sleep at night. What is it that people are worried about? The big down years. The biggest down year we had recently was 2008. There's only been 5 times in the last 60 years that the S&P 500 has closed down more than 15%. What does volatility imply? Well, it implies maybe a bear market. Now, we've only had 5 times in the last 60 plus years that the S&P 500 has been less than 15% in return. Stock market pullbacks are quite common. Normally, 3 times a year, we'll have a pullback of 5% or more in the S&P 500. That's normal volatility. That's just what happens. It's the cost of being in equities. You're going to have a variation in your account value throughout the year. Hopefully we're doing better and ending up on the right side, but you're going to have volatility. And with volatility are corrections. Corrections are not bear markets. We typically have a 10% pullback one time a year during any normal market cycle. Although pullbacks are common, what we need to focus on are earnings, because earnings are everything. As you can see with this chart, our earnings and our valuations are consistent, so we're where we need to be. Look at the volatility, manage for the volatility, but we want to make sure that we are still in the market, able to participate whenever the sun shines and the grass turns green. And the reason for staying in a mix of asset allocation is that you need to either be quick or be gone, because market rebounds very, very quickly. If you think back to 2020, from January to March, the market was down 34, 37%, depending on which time of the day you looked at it. April, it started its rebound, and it finished a positive year. Markets rebound from corrections very quickly. If you're sitting on the sidelines, you're going to watch it pass you by, and then you're going to hope, oh geez, if it comes back down, then I'll buy it. As you know, that almost never happens. I'm Philip Naiman, Cornerstone Christian Wealth Management. Give us a call if you have any questions, 909-406-1144. Website, cornerstonecwm.com. If you're in Arizona, 928-237-4312. Look forward to hearing from you. God bless.